Welcome to VividBox HQ, where Indonesia is trying to break free from global commodity traders, except China owns the factories. For 50 years, a handful of trading houses in Geneva and London, Glencore, Trafigura, names you've probably never said out loud, have moved the world's commodities without owning a single mine or setting foot in the countries that dig the ore up. They buy Indonesia's nickel at the port, sell it to a battery plant in China, and pocket the spread in between. Some analysts suggest that spread runs into billions a year on commodities Indonesia barely sees a fraction of. Indonesia is done with that. In February 2026, the government built the machinery to cut the middlemen out, a sovereign wealth fund with $20 billion in initial funding, paired with a law letting the president hand monopoly rights to state firms and force foreign miners to sell equity at gunpoint. The target, nickel. The metal sitting inside the phone in your pocket and every EV battery rolling off the line. Jakarta has the legal arsenal, the mines, the processing plants, and yet 6 years into this strategy, the country isn't winning the way it expected. We'll see exactly how that backfired. Because the real buyer of Indonesia's nickel wasn't the West. Watch the line climb. In 2020, Indonesia produced 28% of the world's refined nickel. The data we reviewed projects that share hitting 50% by 2025, nearly doubling in 5 years. Around 80% of all new global nickel processing capacity built in that window went up on Indonesian soil. That kind of share gives a country leverage almost nothing else can. But leverage on a chart means nothing without the legal muscle to wield it. In February 2026, Indonesia built that muscle. The vehicle is Danantara, a sovereign wealth fund stood up under Law 1/2025 with $20 billion in initial state money. In one stroke, it absorbed every major state-owned company in the country, the oil and gas giant Pertamina, the state miner Mind ID, Bank Mandiri and Bank Rakyat, the national grid PLN, the telecom monopoly, Telkom, all of it pulled under one fund answering directly to the president. And the law goes further. Tucked inside the same legislation is a clause giving Prabowo Subianto, who took office in October 2024, the power to hand monopoly rights, direct, exclusive, to any state firm operating in strategic sectors vital to the economy. If the government decides commodity trading qualifies, it can hand the entire trade to a state company by decree. Glencore can't bid. The Swiss traders who priced the spread for half a century lose their seat at the table. On paper, this is the most aggressive resource control law any major economy has passed this decade. The question is whether Jakarta can actually run it. The arsenal looks good on paper. On the ground, the squeeze gets sharper. In Indonesia today, no foreign mining company can renew its license without selling equity to Mind ID, the state mining holding now sitting inside Danantara. The rule is blunt. Foreign owners must give up enough stock for local ownership to reach 49%. In practice, the buyer is always the same. In 2023, Vale and Sumitomo handed over 14% of their Indonesian nickel unit to comply. In September 2025, Freeport-McMoRan, the American giant running the massive Grasberg copper and gold mine in Papua, agreed to transfer 12% of PT Freeport Indonesia to Mind ID on the same terms. Analysts call this reverse privatization. For 30 years, the global playbook ran the opposite way. Developing countries sold state mines to foreign capital, IMF in tow. Indonesia flipped the script. Want the license? Sell us the stock. Refuse, and you lose the mine. The state has discovered something powerful. The leverage isn't in owning the ore, it's in owning the permission to dig it up. But owning the mines doesn't mean owning the value. And that's the trap Jakarta is about to walk into. Here's the catch. Nobody in Jakarta talks about loudly. Over 90% of Indonesia's nickel processing plants are Chinese-owned. When the 2020 export ban forced ore to stay in country, the smelters that rose to handle it weren't built by Indonesia or the West. Beijing got there first and integrated the whole chain, mining, refining, shipping, into one tight loop running back to China. And it cost Western automakers everything they thought they were buying. And here's where it lands in a parking lot near you. Volkswagen announced a major nickel plant in Indonesia in July 2022. Tesla followed weeks later. South Korea's LG, the world's second-largest EV battery maker, committed $9 billion to Indonesian nickel refining in April 2022. The logic seemed obvious. Diversify away from China and qualify for the wave of Western EV subsidies coming through Washington. There's one problem. The U.S. Inflation Reduction Act, the law funneling tax credits into every EV battery sold in North America, has a hard rule. The minerals have to be extracted or processed in the U.S. or in a country with a U.S. free trade agreement. Indonesia has neither. And because over 90% of Indonesia's processing is Chinese-owned, batteries made with Indonesian nickel get flagged as Chinese-linked supply. No IRA subsidy, no tax credit. A Volkswagen built with Indonesian nickel becomes more expensive in the American market than one built with Australian or Canadian metal. The very investments meant to break China's grip on EV supply chains. Billions poured into Indonesian smelters, instead pulled Western automakers deeper into Beijing's orbit. Jakarta got the processing, but China got the value. Which raises the question Indonesia hasn't yet answered. Can a state really beat the traders when it doesn't control the buyer either? 6 years in, the honest answer is, not yet. Indonesia has the legal arsenal. Danantara controls every major state firm. Law 1/2025 lets the president grant monopoly rights at will. Forced equity sales pull foreign miners into local hands, one license at a time. On paper, the machinery to replace Glencore and Trafigura is fully built. In practice, Jakarta still depends on the very players it's trying to displace. Chinese capital built the smelters and finances them still. Chinese ships move the refined nickel out to battery plants in Guangdong. When the metal reaches global markets, it's still trading houses, Swiss, London-based, sometimes Chinese, that price the spread and clear the deals. Jakarta has the rocks, but Beijing controls the value chain, and the traders still hold the keys to the global buyer, and the cracks are showing. The data we reviewed flags rising market pressure through 2025. Opaque transfers of state firms like PT Telkom and PT Krakatau Steel into Danantara. Weak tax revenue, a fiscal gap analysts fear will widen at the mid-year budget revision. Some early indications point to investor nerves about who really runs the fund and whether political appointees can steer $20 billion without it leaking into pet projects. On the trend, the numbers expose Indonesia has built the cage but hasn't caught what's inside it. And it's not the only country trying. Zoom out, and Indonesia isn't alone. Chile is renationalizing lithium under Gabriel Boric, the metal that powers every laptop battery on the planet. The Democratic Republic of Congo, holder of more than 70% of the world's cobalt, is renegotiating its contracts with Chinese miners to claw back state revenue. Saudi Arabia is bankrolling its own giant sovereign fund to reshape global energy investment from Riyadh. The pattern is everywhere. Resource-rich states reaching past the trading houses and the old neoliberal bargain, demanding direct control over what comes out of their own ground. The age of the invisible Swiss middleman, capturing the margin between mine and market, is ending. What replaces it is messier. Sovereign funds with billions to deploy and no clear governance, and Chinese supply chains lying in wait the moment Western investors pull back. Indonesia is the loudest test of whether a developing country can flip the script and keep the value at home. If Jakarta cracks it, the playbook spreads to every commodity-rich state with a wealth fund and a willing president. If it fails, if Danantara drifts into political pet projects and Mind ID can't process what it owns, the era of resource nationalism still wins, just under a different flag. For 50 years, the trader in Geneva priced the world. Now the state in Jakarta wants to. The metal in your phone, the battery in the next car you buy, all of it sits on whether they pull it off. The empire didn't fall, it just changed addresses. That's the story of how resource nationalism is reshaping global power, and why Indonesia's conquest may already be written by Beijing. Thanks for watching. Please like, share, and subscribe for more geopolitical documentaries. See you tomorrow.